Welcome. This session is about the importance of staying within your purchase price when buying a home. Also, the risks, consequences, and options that you have once you do go over or if you go over that budget. So there's the biggest risk is that you could lose your deposit, but that doesn't usually happen. There are some solutions that you can implement. And I have here today Jody Eagen from Mortgage Alliance. I first met Jody Eagen through Metroactive Lifestyle Network many years ago, many years ago. And I was very impressed with his grasp of situations, analysis, and solutions. He has a great mind, and I really respect his abilities. So I thought he'd be a good individual to discuss this topic, someone that specializes in mortgages. I could help with the purchasing of the home and making sure you get the right home and negotiating the price. Jody's good at making sure that you're able to finance it and that you know what the risks are and how to deal with them. Here's what my concern is for some of my clients who sometimes want to go above their budget for the purchase of a home. The risk is this: most banks, when they give you a pre-approved mortgage, they rely on the amount of the mortgage calculations on the lower of the purchase price or the appraised value of the home. So if you're paying more for that home than was appraised at, there may be a gap in the financing. Jody, can you please address this from your experience in terms of what buyers should be aware of and some of the risks and what some of the options are around this?
Thanks, Baldo. Yeah, the emotional premium that can sometimes happen with bidding wars, for example, in a hot market is it can be a situation, as you said, that causes a financial sort of imbalance with respect to what people have for their down payment versus what they purchased for the house and what they're pre-approved for the mortgage. So pre-approval is a really good idea to begin with, so to really know what their limits are. But that usually is dependent on what their down payment is and what they plan to do with that down payment. So if they had more than 20% down payment and they ended up paying more for the house, then as long as it stays within an amount that would allow them to stay within 5% down payment or more, then they can get insurance, mortgage default insurance, which will cost them a little bit over time and distance, but at least they can still purchase the house. Because you're right, there could be the risk if they go into this and if they offer and do a firm commitment well over the value of the house, the appraised value of the house, then they're going to have to come up with a lot of money. And if they don't have it, then they will lose deposit, potentially be sued, etc. That normally doesn't happen, as you said.
Jody, just a quick second. So they still have to fulfill certain bank requirements in terms of debt servicing ratios, correct?
Oh, for sure. Yeah, their service ratio has to be within. That's why the pre-approval is good to get and to understand. If your mortgage broker if they're using a mortgage broker, they should be able to explain to them in a hot market what their limits are. So they may want to have, an 80% loan to value with 20% down mortgage, but they could go to 90 or 92 or something like that. So
well, here's the risk though that I'm finding. Most of my clients, they have previous homes they're selling. They have a good down payment. Some of them even pay cash for their new home. But some of the ones that are buying their home for the first time don't have a big down payment, number one. And second of all, their budget is usually based on their maximum ability to debt service. And if they're looking at reducing, like you say, the loan to value, and they're paying now an insurance fee on top of that, and that they have to pay for a larger mortgage as well. And also, is the interest rate around that now higher? How does that work?
Well, if it's strictly a case that they're going to use insurance, no, that the interest rates won't be higher. Sometimes with default mortgage insurance, the interest rates are lower. The lender's actually protected, right? When you get into 60%, 65, 70% loan to value, where it's not insured, that's your normal rates, but they could be a little bit higher depending on the lender and the situation and how hungry the lenders are to get mortgages.
If they get a higher ratio mortgage, I've heard before that they can reduce the interest rate they're paying.
Yeah, because simply put, the lender who is giving you the money, whether it's a bank or a credit union or anyone like that, is protected. When you're outside of mortgage insurance, then they are completely dependent on you, your ability to pay that mortgage, or the value of that house if they had to foreclose and sell that house, not dropping to get their money back. Whereas with mortgage insurance, they're guaranteed to get their money back because of the insurance. So they're sometimes willing to, negotiate and get that business.
And the cost to the buyer, of course, is a higher debt servicing ratio, a higher payment every month. Correct?
Correct.
Okay.
Yes, because of the insurance that's added to the mortgage. Yeah.
You as a broker, do you actually go through their budget and ask them how much of that budget is flexible in case they do have to pay for higher expenses like the mortgage?
I don't have to go through their budget per se. The debt service ratio does enough of that to determine, what's the flexibility that they have. So to your point, if the buyer is right to the maximum debt service ratio, then going into a bidding war and potentially going beyond that is not a wise idea. And it's something that the real estate agent, when a real estate agent is working with a client who has a mortgage broker, there's a lot of value to be had there, that the two brokers are talking and they understand the scenario. I can't give out financial information without permission, but I can talk about debt service ratios, etc., if they give me that permission. So.
Right, and I totally agree with you, and I'm very sensitive to that. I never encourage my clients to go to the maximum of their budget. It's just, I find there's a risk there they don't have to take.
Yeah.
But again.
Yeah, the added benefit from a cash flow perspective is that with the stress test rate at 4.92 at the moment, I think it is, that protects them a little bit, right? Because you're not getting approved at 2.2% mortgage. You can afford 2.2 for sure. You're actually getting approved at a much higher, but that doesn't help you get approved for the mortgage.
Right.
Your point.
What I have you here, sometimes the reason they want to go higher is they're willing to accept putting in a basement apartment or renting out part of their home to have some money come in to help with the mortgage. Now, in a situation where they're pre-approved for a single family home, and now they're looking at buying a home for at the top of their or just above their budget, but it comes with a basement apartment, or can come with a basement apartment with a little bit of money invested in renovating it, say $30,000 or $40,000 at the low end. How would you handle a situation like that, given that a lot of homes have a offer holdback of about 4 or 5 days?
Well, depending on the situation, let's keep it really simple. If that 30 to 40,000 is accessible to them, then they could forego that. If they bid too much and they had plans for that 30, 40 to invest in the basement, they may have to put it into their down payment. But let's assume they don't want to do that. They really see the value in it. Then what I could potentially do is go to a second lender to give them a second mortgage for, say, a year. Now, it's going to be a bit more pricey than normal mortgage rates, but if they get that second mortgage for a year while they're getting the basement renovated and rented, then at the end of it, they could actually remortgage the whole house, now showing income into the house. Right. So we might take 1 year mortgage out on the first mortgage, take a 1 year mortgage, open after 3 months, excuse me, for the second mortgage, and do the renovations, get them done, remortgage all of it as a first mortgage, showing that we now have income coming in, and they would be
and quite frankly, most first-time buyers will not want to go through all that process. But sometimes, they entertain the thought, and then when I explain to them what's involved, they tend to kind of come down to reality, given their personal preferences and lifestyle. Yeah. So tell me, what are some of the other options and solutions when someone pays more for a house than
there's actually not a great deal of options that are not expensive. You may get a lender, maybe what we call a MIC, Mortgage Investment Corporation, that might look at the value of the house. But if it's just a couple or family moving into a place and there's no plans to do anything with it, then they're still going to focus on that appraisal cost or appraisal value for the house. So if it's maybe a private lender might see some value in it, maybe they can, and this is where the broker has to have strong relationships with people who can see the vision of this location or see the uptake of this in the future, and they know that, you know, in 2 years you could refinance because that market is going to go up. The couple or family can remortgage and take the money out and give it back to the lender and get their first mortgage back up and running. Or it could be, you know, that you're going to get an increase in rate, maybe your pay, your salary, maybe you're going to become a master in one of the trades within the next 6 months and you're going to increase 25% of your salary. You know, they can see the vision like that. But it takes a strong relationship with the mortgage broker and private lender for that type of option.
Now, in some cases, what I've seen is my clients actually going to their family, their parents and relatives to borrow some of the money for the down payment. So I've seen that happening. Yeah. How would you document and handle that from your end?
Well, there's two things in that scenario, which I'm glad you mentioned it, because I did forget that there could be a guarantor could solve this problem. If somebody were to put themselves on the mortgage to commit that they guarantee the mortgage, that's one solution. As far as gifting money or getting money from relatives, the government is really clear on it. And I say government because it's regulated to make sure that there's no, this is to make sure there's no money laundering going on in this country. And it has to do with money that's given by a relative. It has to be, you can't get it from your cousin. You can't get it from a nephew. It has to be a direct relative like your parents or a brother or sister. And it has to be gifted. It cannot be paid back. It has to be documented that it was a gift and there's no expectation of repayment. Then they will take that into consideration.
So it has to be a gift then?
Some people think, well, I'll just get some money from somebody and put it in my bank account. But again, you get 90 days of bank statements to see where the money came from. And if there's a lump sum over I think it's over $2,000 that goes into your account, they need a record of where it came from.
But if it shows up as a loan saying, you know, I borrowed money from a friend and I'm going to pay it back as soon as I can, how does that affect the bank's decision in terms of any calculations or documentation?
Well, to them, it's a debt that's associated with the house, right?
So they have servicing issue.
Yeah, it's a debt servicing issue, and if there is any indication that it's, you know, for buying of the house, it's almost like a second mortgage, and a lot of lenders will not do a first mortgage with someone else behind them as a second,
regardless of whether there's interest charged on it or not.
Correct.
What I've come across is when I had clients that offered guarantors, the bank would come back and ask for them to be on title. Is that every bank, or is it just some banks that do that?
It's not something I've done a lot with, so I'm not completely sure about that. We don't use, there's not a lot of guarantors happening in my world these days, but yeah, my understanding is that they've got to be on title because they have to have the skin in the game, so to speak. They're going to guarantee it. And then at some point, when the people have proven that they've been able to pay this, they have to go back to the bank and take them off the title, take them off the loan and take them off title.
Great. Well, Jody, thank you for that. Is there any other thing that comes to mind in terms of how they could handle when they paid more for a home than what they had originally budgeted?
No, I don't think so. Just in summary, though, if you think about it, just like, you know, you as a realtor do with your clients, they've got to be prepared. They have to plan. They have to have a plan, and they got to stick to that plan. And if they have pre-approval and they're already talking to, whether it's their bank or whether it's a mortgage broker, make sure they understand the financial boundaries that they have and the limits that they have, and what plan B would be if they decide they think they're going into emotional premium that they're going to pay for a house. They have to know what their limits are for that.
And you know what? And that's what I find is when somebody's so emotionally charged that they make that decision to go above their budget, that often it comes with remorse. And I don't like seeing that at all. And that's why I keep them within the budget, because the last thing I want is people to be stressed out after the fact or second guess themselves. So that's why, you know, I take them through a complete process. With me, they don't just buy a house on the weekend. There's an actual process I take them through so that they're emotionally, psychologically, and financially prepared. And I could do that process within a month, or sometimes it takes a year, depending on the situation that they're in.
Yeah.
Jody, thank you. Thank you for sharing your time with me today and answering some questions. I have other topics I like to talk about around financing. If you're up to it, maybe you can do that another time.
Yeah, I welcome that. I can tell you that the group that I'm with the Rinrose Group and Mortgage Alliance, we do a lot of mortgages. We're one of the key people, top 1% in Mortgage Alliance across Canada. And we do a lot of private lending, and we help investors, a lot of private investors.
Great. Thank you, Jody. I appreciate your time.
Thank you.
We'll chat soon, okay?
All right. Take care.
Bye now.